Hello everyone and welcome to the BetaShares Making an Impact all-in-one diversified ethical solutions. Thank you all for joining us here today on this webinar, and I hope everyone is safe and sound if you're in your COVID lockdown, but thanks for making the time. It's a very exciting topic that we'll be covering today, so let's get straight into it. Just an important disclaimer, just to show this first and have a quick read of this. Obviously highlighting the key point there is past performance isn't indicative of future performance. I'll just get everyone a moment to read the rest of that. Fantastic. And as always, if you've attended our webinars in the past, and all those people that are new to the webinar today from BetaShares, all the webinars are recorded. So if you do miss anything, do not worry, it will be sent out to you shortly after the webinar. And as always, please do use that little widget box on the right-hand side to send through any questions. We've been very fortunate, and thank you everyone who sent us questions leading into this. We've got a heap of questions to answer at the end, but please do send more through as we go through the webinar. Fantastic. So in terms of the speakers today, myself, I'm Chris Yates. I'm a director here at the BetaShares business. So I look after the advisor service and support part of BetaShares, and we're also very fortunate to be joined here today by Alistair Mills, who is our director of institutional business and really one of the key people within the BetaShares business around ethical investing. So thank you very much, Alistair, for joining us today.
Thanks, Chris.
BetaShares, what we do provide, not only in terms of a unique ETFs to our Australian investors across those asset classes, but also all the support and service that comes with it. So if you ever need additional information, please do visit our website at betashares.com.au and also sign up for our regular content. We bring out a lot of content around blogs in terms of what we as on the distribution side are seeing, and also our chief economist David Bassanese, who brings out Bassanese Bites every Monday. So please do go on the website there and sign up for those content and blogs, and of course follow us on our differing social media pages, LinkedIn, Twitter and Facebook as well. Fantastic. So a little bit about BetaShares. Hopefully everyone that's joined us today are already BetaShares users, and thank you so much for your support over the years in getting us to where we are today, and welcome again to all those new BetaShares clients or potential clients after this webinar. Who BetaShares is, we are a leading ETF fund manager here in Australia with over 63 different ETFs available on the ASX for our investors. We are now managing actually 19 billion as of 2 days ago. So again, thank you for the support to getting us there. And we've really driven that growth from having that Australian-centric lens and providing intelligent solutions for Australian investors to meet their financial objectives. Excellent. So we're just going to bring a couple of polls before we go into the agenda and the rest of the webinar. Just going to pull that up now. So the first polling question we have here, are you currently invested in ESG? I'll let everyone take a couple of moments to get their answers through there. Perfect. If we bring up the results on that one. So we have 51% saying yes, they are already currently invested in ESG, 25% no, and 24% considering it. So pretty good spread there. The next polling question we have here, if we just bring that one up. Are you currently invested in a multi-asset or diversified fund? And I'll give everyone a few moments again to put their answers through here. Looking pretty strong on the yes front. And we'll just close that off and see the end result. There it is, 61% yes, 33 no, and 6 are considering it. So that's really, really great, considering that we are going to be focusing on using some diversified exposures both in the ethical and non-ethical space today. So moving along with the agenda, what we'll be covering today, and as I mentioned, this is a very exciting topic and a lot of interest and growth broadly across the industry in terms of ethical investing. So Alistair will be covering off the growth of ethical investing. And also the next subject there is, ethical investing. There's a lot of things that you do need to know. There's a lot of grey area in understanding ethical investing. So how do you actually get started with ethical investing? And then finally, just going to cover off what BetaShares provides in that ethical diversified space. So again, using our market leading ETFs in a diversified structure for our ASX investors. So Alistair, with no further ado, mate, I think I will pass it over to you to cover off those 3 key areas. Thanks, Al.
Thanks very much, Chris, and hello everyone. It's fantastic to be here. As Chris mentioned, I hope everyone's staying well in pretty unfortunate circumstances, but it's a pleasure to be here, and thank you very much for attending. Just to get us started, I thought it was worth covering a bit of the background of the growth of the ethical investing landscape. But before I do, there's a heap of terminology that gets thrown around in this space. Ethical investing, responsible investing, sustainable investing, all of those can really be put under a very similar umbrella. Sustainable might have more of an environmental tilt. Then you've got ESG, or environmental, social and governance investing. Another term, really looking at how companies compare based on scoring across those metrics. Again, these will all get used interchangeably, so don't worry too much about those. The last one, which is slightly different, is impact investing. And this is when you're looking at investments more to try and drive change, whether that's through environmental, so decarbonisation, gender equality, or just general social improvement out there. So impact investing is another space, and is a newer one where we have brought out an exposure more focused on this area, which we will touch on briefly later in the presentation. Just looking at sustainable investment as a whole, I don't think it's misunderstood anymore that sustainable investing is actually now mainstream. It's no longer a niche area. If you look at the US as a guide, it's estimated now that 1 in 3 professionally managed investment dollars is now done through a sustainable lens. So that's a third professionally managed investments in the United States that are doing it through some form of sustainable focus. You look at the growth here in Australia, it's also been on a massive trajectory. To give you an idea across our product suite, so 63 ETFs, on the global equities space, the #1 fund for inflows this year to date 2021, has been our global sustainability leaders ETF, ETHI. So that just goes to show how much interest there is in the space. I think as well, if you look at the number of registered attendees we've had to a webinar like this, just really goes to show how much interest there is in the space, with more and more options coming around for investors. It's really quite obvious when you look at this chart, which just illustrates the cumulative flows across funds. So this is for all global equity funds across the globe, unlisted funds. In orange, it shows the cumulative flows for ESG, or those with a sustainable focus, and in grey for those that do not have a sustainable focus. And this data goes back to when Morningstar first brought in this label, so the end of 2018. And as you can see there, whilst those without have actually really struggled, and we've seen net outflows, those with an ESG lens or a sustainable lens have really maintained very, very strong, consistent inflows. So it just really goes to show that glacial shift in investor preference. I should mention this doesn't include ETF flows. This is just for unlisted funds across the globe. The #1 pushback you tend to hear when it comes to responsible investing is most people think that if you're going to invest to align with your principles, you have to sacrifice performance. And that typically, I mean, the #1 reason a lot of people invest is to grow their wealth or gain income. So they may not be comfortable in doing that. But the fact of the matter is this is absolutely not true based on historical data. If you look across major asset classes, so Australian equities, global equities, and then multi-asset. So multi-asset is going to include things like the diversified funds we're talking about today. Across nearly all time frames, those responsible in funds have actually outperformed their category averages. The only time frame shown here is the 1 year, and this is cut at the end of last year. So 2020, it was global equity funds where they had slight underperformance versus their peers. Now, I had a question sent through from Matthew, and look, we've had loads and loads of questions sent through, as Chris mentioned. I'll try and answer them sort of naturally as we go through, but then we'll have loads of time at the end as well. But Matthew asked a really interesting one, just based on the attribution of these funds, how much of the outperformance can you put down to the sector tilts or the factor tilts of these, as opposed to the benefits of ESG? And really, if you look at the sector breakdowns, often you will have more of a technology tilt. Some of them have more healthcare in there. So technology has been a really, really strong performer, as you'd be well aware. But actually, if you go under the hood and look at the companies that make it into these types of exposures, those which are treating their environment, their employees, and their customers well, they're really high quality companies typically and really built for the future. And you look at the outperformance of ESG as a factor, it's been really, really consistent. Now, there may be times, typically you'd have an underweight to resources companies. So where you do have resources booms, you may miss out on some of that upside from that sector. But as we see the growth in more green technologies in that space, and more exposures, giving you exposure to decarbonisation resource companies like clean energy or enabling solutions, we could imagine this would enable sort of a broader sector profile as well. But consistently, and you look at the long-term performance, ESG is consistently driving strong returns. So sacrificing returns is actually a myth. Just to give you an overview of the BetaShares ESG suite, we now manage 8 different exposures, over $3 billion across these, ranging across all major asset classes. So starting on the left, fixed income through GBMD. Up at the top, our international equities exposures, so FE, the currency hedge version, HETH, and then that impact exposure, Earth, which is looking at more decarbonisation solutions, including renewable energy. So that's the newest one off the block. And then Australian equities, we have FAIR, and down at the bottom, the 3 diversified funds, which we're going to cover in more detail today. If you look at how BetaShares sits compared to our peers in the Australian ESG exchange traded fund space, over the last 12 months, we've taken in just shy of 2/3 of all assets going into ESG ETFs there. Why is this? Really, it comes down to, we have a very, very strict philosophy when it comes to sustainable or ethical investments. The first is that we really feel it's extremely important to create true to label exposures. You don't want to be greenwashing exposures. Some of you may be aware there are exposures out there which have an ethical title, but you may see holdings within the basket which you wouldn't expect to see. And through that, we realize that ethical investment is not just an off-the-shelf solution. Everyone has a different idea of what they deem ethical compared to others. So in order to capture this, we've gone for the strictest and most true to label funds as possible, because it is much easier for you to add things back into your portfolio rather than trying to remove them. And this gives you much more control over your portfolio if you want to add back in some resource companies or whatever it may be. It's also really important, if you look at how the world has changed, something that 5 years ago may have been deemed as ethical may not be today. And this is constantly evolving. And through that, it's really important to have some form of just slight oversight by a responsible investment committee who can continuously screen through these companies and look out for controversies which may happen. And that enables us to really build these funds with decades ahead in mind, as opposed to just for the here and now, really try and future-proof these exposures and make them really adaptable. And then just finally, engagement and voting. This is one area where traditional passive exposures have potentially come under some scrutiny compared to active peers, where it comes to how they engage with the companies that they hold within their baskets, how they vote at AGMs. We're extremely active and engaged with the companies in these baskets, maintaining constant communication and always voting in line with the responsible investment parameters of these funds. This is fully transparent as well. So for you as an investor, you can see all of our engagement and all of our votes, which are published on our website, display over the last 12 months. So definitely go and have a look at that. Now, there's a lot going on this this slide, but it just goes to show you how strict we really are when it comes to the screening and developing these funds. So I'll give you a couple of examples, and you can look through this slide. But we have a zero tolerance to fossil fuels, for instance, any human rights violations or mandatory detention centres. We also have screens for gender diversity as well. Animal rights is in there, so a whole gamut. And you can see, really, if you're looking for more information on these individual exposures, really implore you to go and have a look on the website, because you can see the full methodologies of each of the underlying funds, which are the ones which make up these diversified funds. So hopefully that gives you a bit of an overview and some insight into the ethical investment landscape, and also BetaShares' view on how we develop products in the space. But with all of that information, and there's so much out there, it can still feel like a bit of a minefield out there. So hopefully to give you a few tips in terms of when you are starting, and really these do actually apply to anyone starting out their investment journey. There are pros and cons, as with anything. On the negative side, because there's so much information out there, you don't sometimes know where to start. You also don't necessarily have a load of time to make yourself an expert in this area, whether that's through other interests or just not able to do it. The other issue some people come across is when you're starting out, typically you might have a lower starting balance, which can give you or feel quite intimidating when you're trying to build a diversified portfolio. But on the contrary, the earlier you start, the longer you have for an investment time frame. This has some real benefits. The longer you have, the more you can benefit from compounding. You also have less sensitivity to short-term volatility, because you can ride out those market lows to hopefully to new highs. So really there are some benefits to starting out. It's not all negative. But to give you some tips in order to how best get started from just a standard but also ethical lens, the first one I'd say is try and build your portfolio in the most efficient way possible. You don't necessarily need to make hundreds of trades when only a few will do. And an ETF is an excellent way for you to get broad diversified exposure in a few trades. One step further that's now available is diversified ETFs. So in a single trade, you can get a really robust portfolio across a multi-asset class. The other thing would be seek low-cost quality investments. Aim for long-term, high expected returns, as you would expect. But the key one here as well is diversification, which I sort of touched on. That's your best form of risk management and the cheapest one. It's much easier to diversify yourself properly to weather different market environments rather than trying to time markets all the time, which has been proven to be incredibly difficult. Invest as regularly as you can, and if you can, periodically. This takes the emotion and out of investing and really benefits on a compounding basis further. Don't be distracted by short-term volatility, as I said. But when it comes to ethical investment, really make sure you're looking for true-to-label exposures. Now, ETFs are fully transparent, and your ethical investment should be transparent when it comes to their process and what they're holding and how they engage with those companies. So for all of our funds, you can our passive funds, you can download the full portfolio holdings from our website and make sure they align with your principles. So just moving straight into the actual ethical diversified ETFs, which is really why we're here and what we want to talk about today. What are they? Now, these are all-in-one multi-asset solutions, as I discussed. They're built using our ethical ETFs, so ETHI, FAIR, and GBND, and enable you to get access to 3 different risk profiles, from balanced to growth to high growth. Cover a range of asset classes, and through one simple trade, you can get access to hundreds of securities. It's a really, really efficient way to diversify yourselves. Just looking under the hood slightly, so these are available, as I mentioned, balanced growth and high growth. Really simple for you to purchase, whether you just use a brokerage account or speak to your financial advisor. All you need is that 4-letter ticker there, whether it's DBBF for balanced, DGGF for growth, or DZZF for high growth. The management fee of these funds is 0.39%. So give you an equivalent, if you invested $10,000, that would cost you $39 per annum. So that's really, really cheap on a relative basis. It's also one of the key benefits of these funds is the management fee themselves is actually less than the sum of the funds. If you were going to implement these yourselves using the direct ETFs, you can actually access these for a lower all-in management cost due to the scalability. There's one other key benefit to these compared to some other, and because they're built with our ETFs, which are all Australian domiciled and exchange traded funds. Now, I'm not a tax advisor, but when it comes to financial year end, there can be some tax efficiencies by using Australian domiciled ETFs as these holdings from a capital gains basis, but always speak to a tax advisor when it comes to that. On the balance side, you're looking at a 50-50 growth and defensive split. Growth obviously tilts more towards equities, and then high growth is predominantly equities with a 10% exposure to fixed income. Now, each of these risk profiles are going to suit different types of investors. The more conservative you are, the more defensive assets you'll typically have. So the balanced option is going to have more defensive assets and therefore lower volatility, potentially better for those with a shorter investment time frame who don't have as long to ride out those peaks and troughs. The growth one, for those who do have a stronger risk appetite, and then up to high growth, those with the longest investment time frame. Potentially and historically has delivered the highest long-term returns, but with that does come more risk and more short-term volatility. So this should give you an idea as to what sort of investor, and they're designed for different risk profiles. They can be combined together, and you're fully flexible in how you want to create your portfolio if you wanted to use these as building blocks. Going into a bit more detail in terms of how you can use these. Now, the obvious one is as a one-stop shop, as your core ethical holding. Like I said, in one simple trade, you can use these to gain access to a multi-asset ETF portfolio, extremely true to label and aligned with your investment philosophy, knowing that the robust portfolio has been built by an institutional fund manager. Aside from that, or with that, that actually makes them extremely good investments for people starting out, or if you're looking to build a portfolio for your children or grandchildren. It's a much, much simpler way than having to rebalance and manage your portfolio on your own. The other way we see people using these types of exposures is if they're just looking to consolidate their holdings, rather than having 20 to 100 different stocks or wherever you may have. These can be a really simple way for you just to consolidate the number of holdings, but still know that you're truly diversified across a large number of securities and asset classes. And then slightly differently and slightly more hands-on, some people use these as a really efficient core of their portfolios. Knowing that you've got a robust core in the middle of your portfolio, which you can just top up and manage, enables you to spend more time on the exciting bits around the side where you may want to use individual stocks or active managers or some thematic ETFs and really tilt your portfolio and personalize it. So this will make it a really efficient way for you to know that the core of your portfolio is robust and you can do some tilts around the side. And then just finally from my end is just looking at the relative performance of each of these exposures. As you can see, the top line there in the grey is DZZF. That's the high growth portfolio. So as you can see, it's delivered the strongest historical returns. And these are simulated returns. The diversified ethical ETFs only came into fruition in December 2020. So this is built using the indices of the underlying exposures, rebalancing them on a quarterly basis to their allocations. So grey is high growth, orange is growth in the middle there, and then at the bottom in the sort of beigey pink colour is balanced, DBBF. So as you would expect, balance over the long term has had lower performance, but with lower risk and lower volatility. So each of these may suit different objectives and different time horizons. I should note that the funds are built, so with their asset class selection, they're rebalanced to their strategic asset allocation weights on a quarterly basis. So each quarter they're rebalanced using the 3 ETFs across the board.
Yeah, thank you, Alistair, for covering off the ethical side of it. And look, just to note as well as what BetaShares has in that diversified space is also the BetaShares Diversified All Growth ETF, which again is just another easy access point for investors with either a low capital base or are looking for a simplistic way to get a diversified equity part of their portfolio, but not necessarily going down the ESG space. They can do it through this fund, which trades on the ASX at DHHF. And that's, again, a very low-cost solution at 19 basis points. And again, giving that diversification, it's great for that simplicity around one trade. And again, what we are seeing for this is investors that may have a low capital base or even looking to get their kids or grandkids into investing and growing their own wealth and starting that investment journey. They can use this diversified all growth ETF as a great starting point at that low cost. What I will note again, because it is all growth, you're not going to get a fixed income allocation in that. But as Alistair sort of mentioned, if it's something that's used as either the growth portion of the portfolio or for that long investment time frame, it really is a great option around that. Now, just some things to consider through the presentation today is obviously there are a few things around investment risk, of course, when you're investing, around asset allocation, market risk, currency risk, underlying ETF risk, and index tracking risk. As mentioned at the start, there is no guarantees around future outcomes. They are uncertain, and probably one of the key ones today is the information that has been provided is general information only, and we have not taken into account anyone's personal circumstance, but we always do implore that if you are looking for that extra level of advice and guidance, please do go seek a professional advisor. And as mentioned at the start as well, if you are looking for any additional information on any of our funds, please do visit our website. There's a heap of content and fact sheets that you can go on there and get all the information you need around the funds and distributions and things like that too. So that brings us along to questions. And as mentioned, there was a heap of questions, and Alistair covered off a lot of those that had come through prior to the webinar as he went through there. But there's some other ones here, and Alistair, I'll just get you to cover this one first. Do you feel like there is less opportunities in the domestic Australian market for green investments when compared to other countries around the world?
Yeah, it's a really good question, actually. And I mean, if you look at the Australian market or share market, there's a huge weight to resource companies, you know, your miners, things like BHP and Rio, which typically wouldn't make it into most of these ethical funds from a sustainability or climate basis. But then the big four banks as well make a huge amount of their revenue based off lending to these companies. So the Australian market through its tilts is probably not as amenable. There's lower proportion of technology, for instance, so potentially less amenable just on a basis. The next issue you might have is reporting and data in the Australian market. So in the US and Europe, companies provide a lot more transparency in terms of their carbon footprint and emissions. So that can make it potentially easier. But that being said, we do still have an Australian sustainability leaders ETF here. It is still extremely true to label and well diversified. There are about 80 stocks within that portfolio, which meet all of our really strict positive and negative screens. So you can actually build a really robust diversified portfolio there. When you compare that to the global market, I mean, as you'd expect, that Australia is just one small proportion of that. You're going to have a lot more stocks to choose from in the global market. So I don't think it's necessarily a hindrance. You may need to take a slightly different approach from building these ETFs as we have. There are some subtle differences, but you can still build a really true to label one.
Fantastic. There's another, there's probably this question here I can probably lump into two, but do you have or are you considering a clean/green energy fund? And also the other question around that too that came through is there an ETF geared towards innovative companies focused on things like carbon drawdown technologies? Do you want to just cover off that? I know you highlighted Earth earlier, but maybe go into a little bit more detail there, Alistair.
Yeah, happy to do so. And yeah, good news. Earlier this year, we actually launched the BetaShares Climate Change Innovation ETF, Earth. And this is specifically focused, more of that listed and liquid impact exposure that I mentioned, but focusing on those companies and technologies which are really trying to drive that shift to decarbonisation. So through this, you get your renewable energy exposure, but it goes beyond that as well. Things like enabling solutions, building efficiency, water and waste, all these technologies and solutions which are enabling companies and governments to meet those net zero targets by 2050. So that should be exactly what these investors are asking for there. And we're pleased to say we've just brought that to market earlier this year.
Fantastic. And look, another one here from Andrew Smith in terms of, and following up on what you've just covered there in terms of Earth, ESG funds have been criticised in the past, e.g. by the Barefoot Investor, for being more market spin than substance to charge higher fees essentially. What is the reason for charging a higher MER for an index like Earth, which you just covered there, than some of the other indexes out there?
Yeah, there's such a broad range of different exposures out there. And like I said, and for some of them, he's quite right that there can be a level of greenwashing. You see many funds slap a label of ethical or sustainable on their funds and potentially aren't the strictest when it comes to that. When it comes to our way of building these funds, and spoke about it when talking about the philosophy, but these are index trackers, but with the index methodology, there's an extremely large amount of work that goes behind compared to just say a market capitalization index. So the Australian market, we've got A200, the cheapest Australian equity ETF in the world. It costs you 0.07% per annum. Really simple methodology, just market cap weighted. Fair, on the other hand, you've got both positive and negative screens going through the Australian market, looking at companies on their revenue generation, how they impact around them. It's a lot more capital intensive to build these sorts of exposures. Mainly you're sieving through heaps and heaps of data from an index basis in order to create those funds. So typically you'll find ETF management fees represent how simple the exposure is to create. And you know, there's a bit more complexity to building an exposure that is a really true to label exposure versus just a passive index based on the broad market. Now, I will say that whilst these are more expensive and people have got used to extremely low management fees in the ETF basis, but these are still incredibly competitive when you compare them to active peers. And I mean, it's a separate debate, but the whole active versus passive performance side of things, these funds have themselves performed extremely well compared to all of their passive and active peers on a historical basis.
Fantastic. Thank you for going through that. And look, another one probably just following on that and the points you made in terms of the sort of what happens in the background and the construction and the due diligence around constructing these more ethical ETFs. There is a question here on that. So how does BetaShares actually do that DD and verify the ESG credentials on each company in the ETF? And that's a question from Mark.
Yeah, thanks for the question, Mark. It's important to remember that these are index funds. So BetaShares whilst the Responsible Investment Committee is involved in screening those companies for the index, for Ethy and Fair, the index provider is NASDAQ. So they're providing a lot of the basic data there. There's various layers across how these are constructed. The main initial one is the climate data. So for Ethy, we use true cost data, looking at the carbon intensity of each of these companies and how it comes through. And then the Responsible Investment Committee and a big team behind them are sieving through all of this data themselves, checking through revenues, annual reports, and various public data to ensure that these align with each of these things and looking out for controversy. So it's a continuous basis, and the Responsible Investment Committee meet regularly to keep an eye on and keep on top of all of these companies that make it into each index.
Fantastic. And a question here, which you're very well placed to answer, given you do a lot of work around the capital markets desk of our investors trading into our ETFs. There's a question around liquidity around ETFs, not just necessarily the ethical ones here, but just in terms of liquidity in the early lives of an ETF compared to a larger fund.
The first thing I would say is when you're looking at an ETF, in order to even bring an ETF into market, the underlying exposure needs to have a certain level of liquidity. Because you're quoting the ETF throughout the trading day, you need to be able to price the underlying holdings. So really what that means, an ETF's open-ended funds. An ETF, really, your first level of liquidity that you should consider is the liquidity of the underlying exposure. So for all of these funds, they're highly liquid underlying exposures, whether it's Australian equities or global equities. The basket trades huge amounts of volume in the underlying portfolio. So that means the fund is as liquid as that. Now, when a fund, most of your buying and selling in the initial stages will be off market makers, and they're liquidity providers who are there to provide liquidity throughout the trading day, and they'll be on the bid and the offer. So they'll be there. If you ever want best execution help, you can always call through to our capital markets desk, and we can ensure that you get best execution across the board. One thing, as an ETF matures and you get more and more people trading it, you may see natural, buyers and sellers sitting on a tighter spread there. So there can be some initial benefits, but I'd say your basis start when an ETF first launches, it's going to be as liquid as the underlying portfolio. And then as it grows, it only gets more and more liquid, as opposed to being illiquid to begin with, and then reaching a certain size of liquidity.
Fantastic. Thank you very much for covering that. Should we try one more question? I'm just going to have a look at what else we've got here. There is a question that's come through around banks not being in the index, being the big four banks. Do you just want to cover off what probably is the key screening metric that excludes those big fours currently in terms of FAIR?
Yeah, of course. So none of the big four banks make it into FAIR, and this is because when you look through their revenue streams, a large proportion of it is from lending to fossil fuel providers. And going back to one of the earlier slides where I showed all of the screens, we have a 0% tolerance for direct fossil fuel production, but then only a 5% allowance for indirect. So if any bank is making more than 5%, which is obviously a very small proportion of their revenue from lending to fossil fuel providers, they will be excluded from the index. And this is where the big four banks fall short on that basis. So you won't see Commonwealth, Westpac, and NAB, any of the big four banks coming through. They get excluded. There are some other financial companies that do make it through, but it is based on that they meet these screens.
Excellent. Thank you very much, Alistair, for covering all those questions, and thank you for going through the presentation. And of course, thank you for all of our attendees today for joining us and taking the time out on their Thursday to go through this BetaShares webinar. As I mentioned earlier, it will be sent out, so if you did miss anything or you have any additional questions, please either go on the website and you can obviously send those through or give us a call. But then thank you so much for joining us, and we hope you join our future webinars, which will be coming out very shortly. Have a good Thursday. Thank you.
Thanks, everyone.